Hello and welcome back to Deep Dive. We're the place you come to cut through the noise, get straight to the point, and really find those fascinating bits of knowledge.
That's right.
Today we are diving deep into the latest results from a giant in India's digital world. 197 Communications Limited. You probably know them better as Paytm.
A big name.
Exactly. We've got their official earnings release for Q1 FY26. That's the quarter ending June 30, 2025. Plus the consolidated financials, the auditor's reports, the whole package.
All the details.
Our mission, put out the key insights, figure out their strategy shifts, and understand what it all means for Paytm and the wider fintech scene, especially as they try to become this profitable, AI-driven leader.
It's a big transition for them.
Definitely. Get ready for some aha moments, I think. Okay, let's just jump right in because honestly, the headline here is massive. Paytm hit a huge milestone.
Yeah.
For the first time ever, they're profitable. Across all the main financial metrics, that's a pretty big deal for a company like this, isn't it?
Oh, absolutely. It's huge. What's really interesting is the actual number. They reported a profit after tax PT of 123 crore for the quarter.
Okay, 123 crore.
Yeah. And look, it's not just barely profitable. This is like a 963 crore improvement year on year. Massive swing.
Wow. Okay, that's a huge improvement.
And maybe even more important, their EBITDA, earnings before interest, taxes, depreciation, amortization, that operational profitability measure, it's positive. It's 72 crore, a 4% margin.
Right.
So that tells you there's a real deliberate shift happening. Disciplined costs and that AI leverage they talk about, it seems to be kicking in. They're clearly focused on making money sustainably now.
That profitability, that's the headline win.
Yeah.
Definitely. Especially after all those years focused purely on growth. So, okay, usually when a company turns that corner, it means the revenue engines are really firing, right? Where's the growth coming from?
Exactly, you nailed it. Overall, their operating revenue, up 28% year on year, reached 1,918 crore.
Okay, solid growth.
And actually, if you adjust for the entertainment ticketing business they sold off, the like-for-like growth is even better, 31% year on year.
Right, right.
And this comes mainly from three key areas. Let's break those down. First up, payment services, this is, the heartland of Paytm. Revenue here grew a solid 23% year on year. That's 11,110 crore.
Still the biggest piece.
Definitely. And their net payment revenue, so after costs, grew even faster, 38% year on year to 529 crore. They put that down to better margins on processing payments and just adding more devices out there.
Makes sense.
And here's the number that shows their scale. GMV, gross merchandise value, basically everything transacted through them. That jumped 27% year on year. It hit 5.39 lakh crore.
5.39 lakh crore, that's huge.
It's massive. It really shows how embedded they are in everyday Indian commerce. And, more transactions mean more fees for them. And look at their merchant devices, those sound boxes and card machines. Subscriptions hit an all-time high, 1.3 crore. That's up 21 lakh over the year. They say it's driven by better devices and their service network. They keep talking about their undisputed leadership using this AI-powered platform.
Right.
And what's smart, I think, is things like the zero-cost QR solution. That brought over 4 crore small merchants online. And the sound box, giving that voice confirmation, game changer for small shops.
Yeah, those are everywhere.
Exactly. They're not just fancy tech, they're practical tools. And they're pushing hard into smaller cities too, tier 2, tier 3. You see that in their costs, sales employee costs are up 19% year on year. They're investing in feet on the street.
So payments are strong, growing steadily, very foundational. But then you mentioned financial services distribution. That one really jumps out 100% growth. Tell us about that.
Yeah, this segment is really becoming the profit engine, you could say. Revenue from distributing financial services literally doubled, 100% year-on-year growth, hitting 561 crore.
Doubled. Wow.
Mostly driven by more merchant loans, getting trail revenue from their DLG portfolio, that's a default loss guarantee, and they've gotten much better at collections. Now, the number of actual financial services customers, about 5.6 lakh, that was pretty stable. So the growth isn't really from more customers, it's from bigger disbursements. They're lending more effectively.
Got it. More volume per customer, essentially.
Exactly. And here's where it gets really interesting strategically. Their biggest lending partner, they've just shifted away from that DLG model this quarter, moved to non-DLG.
Non-DLG. What does that mean practically?
Well, it means Paytm takes on less risk, basically. With DLG, they guarantee a portion of the loan losses. Non-DLG, they don't. So disbursements will keep growing, but the revenue growth sequentially, quarter on quarter, will probably slow down a bit
Why slower?
because the non-DLG model has lower upfront costs for Paytm, and it also means less lifetime revenue recognized upfront compared to the DLG model. It's an accounting thing partly, but it's also strategic.
Okay, so less immediate revenue recognition, maybe, but also less risk on their books.
Precisely. It feels like a move towards a more sustainable, capital-light model, maybe getting ahead of potential regulatory changes around these guarantees, too.
Yeah.
They can facilitate more lending without holding the risk directly.
That is a significant shift, creating some immediate upside for maybe a safer long-term path. Interesting.
Yeah. And they also mentioned seeing, early signs of recovery in personal loans and putting more focus back on Paytm money for mutual funds and stocks.
Okay, so that covers payments and financial services. What about the third piece, marketing services? That looked a bit different.
Yeah, it did. Revenue there was 247 crore. That's actually down 23% year on year.
Dale. Okay.
Now, if you again adjust for selling the ticketing business, the like-for-like drop was smaller, about 12% year on year. They said it's mainly because their monthly transacting users, the MPUs, were lower, around 7.4 crore.
Fewer active users impacting ad revenue makes sense.
Right, but they're not giving up on it. The focus now seems to be using AI to get much smarter about targeting ads, delivering better ROI for advertisers, even if the user base isn't growing as fast. So quality over quantity, perhaps.
Okay. You mentioned AI quite a bit now. It seems to thread through everything. How central is it really? Is it just buzz, or is it genuinely impacting the business?
Oh, it seems absolutely central. They literally call themselves early and aggressive adopters of AI. They talk about building AI-first platforms and moving to a machine-first, supervised by humans approach.
Machine first, supervised by humans. Okay.
Yeah, and it hits both sides, efficiency and new revenue. On the efficiency side, think about onboarding merchants. AI does quality checks, figuring out the business type from photos, matching names, reading documents with OCR.
Yeah.
That helps them scale up those quality device merchants without needing tons of people.
Right. Automation.
Exactly. And their transaction monitoring, it's real-time, flags weird stuff, predicts chargebacks. That cuts down fraud, saves money. And customer service. They have these AI chat agents, 24/7, text and voice, multiple languages, high satisfaction, lower cost than a huge call center.
Makes sense. Standard AI applications for efficiency.
Yeah.
What about making money?
That's where it gets maybe more unique. Their Paytm ARMS platform uses AI insights for cross-selling, figuring out which merchant needs which loan or product, optimizing approvals, pricing.
Smart targeting.
Yeah, and their marketing platform uses AI for sharper audience targeting, too. That lowers their cost to acquire customers and gives advertisers better results. They also use AI models to predict which merchants might leave or who might default on a loan.
Predicting churn and risk.
Exactly. High precision, they claim. That improves loan quality for their partners, and Paytm gets bigger bonuses for better collections. It's a virtuous cycle, potentially. And they've added AI features for users, too, like smart filters for travel tickets or a portfolio analyzer for investments. It's not just flashy stuff. It makes the products work better, keeps people using them, leads to more transactions.
So it really does sound like AI is, woven into the fabric now. It's not just a layer on top. It's core to cutting costs and finding smarter ways to generate revenue.
That's the picture they paint, definitely.
So, okay, they've hit profitability. AI is central. What's the game plan now? Where are they heading strategically?
Well, they've laid out some pretty clear focus areas. First, just keep leading in the merchant space in India. More QR codes, more sound boxes, more card machines, getting deeper into both small shops and larger businesses.
Doubling down on the core.
Right. Second, expand credit distribution. That means more lending partners, new types of loan products, and using that AI to keep improving collections. Third, that commitment to being AI first everywhere, using it to scale up how they make money and make the customer experience better. Fourth, getting consumers through product innovation. They seem to feel that making the app itself better is bringing in and keeping users, even without huge marketing spends. So, product-led growth.
More efficient acquisition.
Hopefully. And fifth, looking longer term, they're exploring international expansion. Selected geographies, they say. But they also caution it might take about 3 years to see results there.
Ah, interesting. So planting seeds overseas. That suggests they're thinking beyond just India now.
Yeah, it's a long-term ambition, clearly.
Now, any company this big, especially in India, deals with, regulations, legal stuff, maybe some one-off financial items. Anything notable we should be aware of from the reports These things can sometimes be pretty important context.
You're absolutely right. The auditor's report flags a few things as emphasis of matter. Basically, pay attention to this. First, there's a FEMA show cause notice. FEMA is the Foreign Exchange Management Act.
Okay, 4X related.
Yeah. It came in Feb 2025, involves Paytm and two subsidiaries. It alleges some violations related to investments made years ago. The amount mentioned is around INR 6,111 million.
That sounds like a lot.
It is, but the key thing is Paytm says they're working on resolving it and have already made a provision for potential compounding fees. So they seem to be actively managing it. It's an older issue they're cleaning up.
Okay, managing it. What else?
Then there's a GST-SCN, that's Goods and Services Tax, for a joint venture, First Games Technology. This one came in April 2025. It proposes a huge potential liability, INR 57,120 million plus penalty.
Whoa, 57,000 million. That's massive. What's the dispute?
It's about the tax rate. Should they have paid 28% GST on the whole entry amount for gaming, or the 18% they did pay just on their platform fee? Big difference.
Right.
But here's the good news for them. India's Supreme Court actually put a stay on these proceedings in May 2025, and the JV management thinks they have a strong legal case. So it's a big number hanging out there, but it's paused, and they're fighting it.
Okay, pause for now. Anything else major?
There's an update on their RBI payment aggregator license. Remember, their subsidiary needed RBI approval to act as a payment aggregator.
Yeah, that was pending for a while.
Right. They needed approval for some past investment stuff. They got that approval last August, resubmitted the main application in September, and it's still under process with the RBI.
So still waiting.
Still waiting for the final nod. In the meantime, they can keep serving their existing online merchants, but they can't sign up any new ones for that specific service.
Okay. Like a temporary pause on new business there.
Exactly. But management says it's not having a material impact overall. So annoying, probably, but not critical, they assess.
Got it.
And one more significant item related to ESOPs, employee stock options for the CEO. There was an ongoing issue with SEBI, the market regulator.
Right.
In April 2025, the CEO voluntarily gave up 21 million of those ESOPs. This triggered a big accounting charge, INR 4,924 million, booked as an exceptional item, basically accelerating the cost recognition. The total cost related to those specific ESOPs over time, nearly INR 41,000 million, got moved around in their equity accounts. The upshot is this whole matter with SEBI is now settled as of May 2025. So another past issue resolved, albeit with a big non-cash charge this quarter.
Cleaning up the books, sounds like.
Seems to be part of the theme. And just quickly, there were also some smaller exceptional items, write-downs on a couple of investments. And important to remember, their cash pile got a huge boost last year from selling two things: the ticketing business and their stake in PayPay. That brought in a lot of cash.
Right, those non-core asset sales. So putting it all together, the profitability, the strategy, these regulatory things, what does their overall financial health look like, specifically cash? Do they have the dry powder to fund all these plans?
They absolutely seem to. Their cash position looks very strong. As of June 2025, they had 12,872 crore in cash and equivalents.
12,800 crore.
Oh.
Yeah?
Yeah. And that's up significantly by 4,764 crore over the past year. As you said, a big chunk of that increase came from selling those non-core assets, ticketing, and PayPay rights, which brought in about 4,386 crore.
Right.
So they've got that huge cash balance, plus another 20,000 million from the IPO proceeds that are still sitting in fixed deposits. It gives them a ton of flexibility. They can fund the merchant expansion, the credit distribution, the AI stuff, without necessarily needing to raise more money right now.
So a strong war chest to execute the strategy.
Exactly.
Wow. Okay, that was quite the deep dive into Paytm's Q1 results. We've seen a company hitting that profitability milestone, which is huge. And really leaning into AI, not just for efficiency, but to find new ways to make money. The core payments and financial services look strong, growing well.
Yeah, despite some strategic shifts like that non-DLG move.
Right. And they're navigating these regulatory complexities while still holding a very strong cash position. Gives them options.
Definitely. The picture really is one of a company that seems to have a clear plan, playing to its strengths, using its tech advantage, and making that shift from just growth to sustainable profit.
So what does this all mean for you, our listener? Think about Paytm's big ambition serving 500 million Indians. Now add their exploration of going international. How might this AI-first strategy, combined with actually being profitable now, accelerate their impact? Could we see their model honed in India, start influencing digital finance and inclusion elsewhere in the world?
It's a fascinating question, isn't it? Could the Paytm playbook, now proven profitable and AI-driven, become a template for other emerging digital economies?
Something to definitely mull over. That's all for this deep dive. We'll catch you on the next one.